An 8% withdrawal rate is not sustainable. Well, that's a criticism income investors like me hear sometimes. Investments that yield 8% sound great, but if the stock price erodes over time, the income might too. In many cases, that is true, but not always. These 5 business development companies have histories going back at least 10 years, and if you'd held them for that long, an 8% withdrawal rate worked out just fine. Today, we'll backtest how these 5 companies managed to pay 8% every year for the past decade while outpacing inflation and navigating the 2020 pandemic. When I looked at the holdings in my portfolio that have been around for at least 10 years, I found a pattern. The investments that best delivered on my goals were business development companies, or BDCs. These are private lenders specializing in business loans. My goals are to generate consistent income and stay ahead of inflation. In other words, the value of the portfolio can go up and down with the market, but the income needs to constantly increase. I have 5 BDCs that have been around for at least 10 years. If we plug the 5 into this free backtesting software called Portfolio Visualizer, we can find the answer to the question, if we'd withdrawn 8% per year over the last 10 years, would our initial investment have grown in value? And if so, would it have grown faster than inflation? I'll enter the 5 as equal weight, 20% each, initial investment. 100K is a nice round number. 10 years is the maximum period this free version of the software will calculate for us, withdrawing 8% per year to pay for retirement. Click Analyze and boom, we get more data than you can possibly digest. A little too much, actually. So I'll show you what I found interesting. First up, after withdrawing 8% per year, was the portfolio still worth at least 100K? Survey says, ding, 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 yes. Actually, a lot more than 100K, $186,000. So the portfolio of 5 BDCs didn't just sustain, it thrived. March 2020 was a huge blow for the portfolio, 130K down to 64K because of you know what. That would have been scary at the time, but then it bounced back and went on to new highs. I'm calling these 5 BDCs Income Kings because they delivered a sustainable 8% withdrawal over the past decade while growing in value faster than inflation, not to be confused with the more famous Dividend Kings. Those are stocks like Johnson & Johnson that raise their dividends for at least 50 years, which is great, although it doesn't account for price changes. More importantly, J&J pays about 3% yield, which is typical for Dividend Kings. So it depends on how much yield you're looking for. By the way, if you're new to the channel, I retired in 2017, and that's when I got serious about researching my investments in greater depth, and this channel is where I share what I learn. And if you're not new to the channel, welcome back. I thought the background was looking a little bit dark, so I lightened it up a bit. I mostly focus on stocks and funds paying consistent yields of 8 to 12%, and if you'd like a copy of my portfolio, it's available via Armchair Insider, link in the description, it's free. Next, we'll look at those 8% withdrawals. The first year, 2015, was a bit less than $8,000 out of the 100 because the backtest begins in February 2015, so the first calendar year is only 11 months. By the second year, 2016, the 8% was worth more than $8,000 because the portfolio had grown in value. Over $9,000 for 2016, I think is quite good. Over the 10-year period, the trend is clearly up, and for the last full year, 2024, 8% equated to a withdrawal of more than $15,000. Next, we'll look at the income generated by the BDCs. Even though we're withdrawing 8%, the income could be more or less than 8%. For example, Main, MAIN, often pays less than 8%, but appreciates in value more than its competitors. The others typically pay more than 8%, and in this example, anything over 8% was reinvested. Once again, the trend was up and to the right. I thought it was interesting that in 2022, which was a terrible year for the stock market, income was a bit over $14,000 and the 8% withdrawal equated to just under $11,000. That meant that about $3,000 was reinvested back into the portfolio at a time when prices were quite cheap. That would have helped grow the income, and we can see that 2023 had a nice bump in income from about 14K to almost 17K. Of the 5 BDCs we're looking at today, my largest holding is ARCC. It's yielding just over 8% and has a history of consistent dividends going back 20 years. Snowball is handy for distribution charts like this one, but I mostly use it to combine my stocks from 3 brokerages into one simple dashboard. Sometimes I'm looking to sell low-yielding funds to buy higher yields, so I'll rank by yield to see how I want to rebalance my portfolio, and the calendar function lets me see how many dollars will arrive on any given day of the month. Link in the description for a discount and a free trial. You can also access distribution charts on Seeking Alpha, but I mostly use that one for deep research on a specific investment. For ARCC, the one I just mentioned, the best recent analysis I found was by ADS Analytics. It reviews the most recent quarterly results, and I'll cut to the chase. They rate ARCC a hold. If you want to read their ARCC breakdown, I'll link it in the description, and I'll include a link for a discount on Seeking Alpha and a free trial. What about inflation? 100K to 186K over 10 years sounds like it kept ahead of inflation, but by how much? We can check this little box to discount the value of the portfolio by the Consumer Price Index. The result is 136K, which is excellent. That means that even after withdrawing 8% per year, the purchasing power of that initial 100K had still grown by 36%. This website we're using is called Portfolio Visualizer, and everything I'm showing you is the free version. The paid version goes back further than 10 years, but most of my portfolio isn't that old, so I haven't used the paid version. I'll link it in the description. There's no discount, and I don't receive any commission from them. Let's add a yardstick, the S&P 500. What if you just held the S&P 500 and sold 8% per year to pay the bills? That would have worked too. The S&P 500 didn't fall as much as the BDCs did during March of 2020, but the BDCs actually delivered a higher return if you stuck with them. The S&P 500 also stayed ahead of inflation. After withdrawing 8% per year and adjusting for inflation, the S&P 500 had still increased the purchasing power of that initial 100K by about 14%. We won't cover income for the S&P 500 because it doesn't really produce much, but we can look at withdrawals. Selling 8% per year worked out reasonably well, although it's interesting to see that in 2021, that 8% was more than 8% of the BDC portfolio. Then in 2022, the bear market hit the S&P 500 harder, and the 8% withdrawal was less than it was for the BDC portfolio. In other words, income from the BDC portfolio was more consistent. So why do BDCs pay these crazy high yields? They borrow money at low long-term rates, and then they lend out at higher short-term rates. The difference between the two is their gross profit. Those loans might be to fund growth, for example, buying manufacturing equipment, or an acquisition, such as buying another business like a competitor or a supplier. The reason that BDCs pay out so much income is that, much like a REIT, a real estate investment trust, they're structured as a registered investment company, or RIC. The IRS provides BDCs with tax benefits if they pay out at least 90% of their net investment income to shareholders. The result of all of that is that BDCs are structured to deliver most of their returns to shareholders in the form of income rather than appreciation. They can still appreciate a bit though. BDCs pay ordinary income, which doesn't offer special tax benefits, so they tend to be more popular with retirees rather than investors that are still receiving a paycheck. There are about 50 BDCs, and they're not all great investments, so I wouldn't just buy the ones with the highest yields. You can buy them individually. I'll link reviews to each of the 5 I mentioned today in the description. Or you can buy a fund that picks them for you, like Putnam's PBDC fund. If you'd like to learn more about BDCs and why they pay such high yields in more detail, I recently interviewed PBDC's fund manager, Mike Petro. I'm not suggesting that you should dump all your income portfolio and then buy these 5 BDCs. That's way too much concentration, and I want to spread out my risk to various asset classes. The point I want to make for income investors is if you don't have an allocation to BDCs, then compare your current income investments to some BDCs using backtesting software like we did today to see if they deserve a spot in your income portfolio. Interest rate sensitive investments like REITs, utilities, and corporate bonds perform poorly during periods of rising interest rates. That means that just like the Kenny Rogers song, you gotta know when to hold 'em. Know when to fold 'em. You get the idea. Today has shown us that these 5 BDCs, which I consider among the best in class, have navigated rising and falling interest rates exceedingly well. Could you sell 8% of the S&P 500 each year instead? Maybe. I don't know if it would work over a longer period of time. It would probably depend on your timing. Psychologically, though, I would find it difficult to sell SPY or VOO during a bear market at depressed prices. I already own the 5 BDCs covered today, but only one of them is at my max 5% allocation, and that's the one I mentioned earlier, ARCC. Going forward, I plan to increase my allocation to the other 4, not all the way to 5%, but I've been a little bit too price sensitive with some of them. If you'd like to hear the PBDC fund manager explain how BDCs pay high yields, click here for the interview with Mike from Putnam. That wraps it up for this look at 5 BDCs with a 10-year history of sustainable income. More Armchair Income coming soon.
Armchair Income, that's my hustle and my groove.